Hi, I'm Nic Spicer and welcome to the Pmx Quarterly update. The third quarter of 2017 saw continued improvements in the global economy. Growth was generally up and unemployment was generally down. The OECD expects global growth to be around about 3.5% this year, an increase over the 3.1% of last year. It expects 2018 growth to be even stronger at 3.7%. Markets generally shrugged off an increase in geopolitical risk, particularly around North Korea's nuclear and missile testing program and the possible responses from the US to that nuclear testing program. Global developed market central banks held rates steady, but adopted a decidedly more hawkish tone around future rate rises and decreases in quantitative easing. Emerging market central banks, on the other hand, actually decreased rates on lower inflation. Brexit uncertainty continued as Theresa May's reset speech in Florence was overshadowed by Tory infighting, as well as a disastrous conference speech, and EU worries that the UK doesn't quite know exactly what sort of Brexit it really wants. How did markets perform over the quarter? They generally shrugged off the increase in geopolitical risk and focused instead on the strengthening economy. Both equities and bonds were up over the quarter. While still positive, a generally strengthening pound did dampen the sterling returns on overseas assets for UK investors. Emerging market equities were the star performer of the quarter, up 4.5% in sterling terms. European equities were also particularly strong, up 3.5%. Global listed property was the weakest performer, a function of the strong pound as well as a slight uptick in global rates. Developed Asian equities were also slightly weak over the quarter. How did portfolios perform? Performance was strong over the quarter in both absolute and relative terms. With the FTSE 100 up 1.8%, PortfolioMetrix portfolios were up in the range of 0.7% to 3%, depending on the riskiness of the actual portfolio. Core active portfolios generated outperformance through both asset allocation and fund selection. With regards to asset allocation, overweights to emerging market equities, European equities, as well as an underweight to US equities were all helpful. An overweight to Japanese equities was slightly less so. Looking forward, what can we expect? It seems very likely we're going to get increased monetary tightening over the following quarter, with a rate rise particularly likely in the US, but a possible rate rise in the UK. Rate rises are often a risk to markets, but it seems unlikely that in this case they will derail the strong market environment. A far bigger worry are the geopolitical risks. A war on the Korean Peninsula would be catastrophic. This is a low probability event, but its high impact does mean that it needs to be considered carefully. Catalonian secession is also a risk, given that it would mean Catalonia crashing out of both the euro and the EU, and possibly derailing the EU's strong economic performance. Closer to home, things are not looking particularly rosy. The UK is actually lagging the global economic uptick, with the OECD forecasting a fall in UK GDP growth from 1.8% in 2016 to only 1% in 2018. Brexit negotiations are progressing in only fits and starts, and Theresa May's premiership hangs by a thread. An early election should be an impossibility given that the last one was only in June, but cannot be ruled out given Tory infighting. Meanwhile, a resurgent Jeremy Corbyn is waiting in the wings, and investors remain concerned about some of his less market-friendly policies. Thanks for watching our update, and expect a lot more from us over the following quarter.